Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-string support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. We've just completed the 6th anniversary of the launch of the Moneymakers Investment Trust podcast, and what an eventful period it's been. Before talking to my guest this week, who is Stuart Widdowson, the manager of the Odyssean Investment Trust, a UK small-cap specialist fund, I thought it might be worth making a couple of comments. So much going on at the moment with the Iran war, the ceasefire that may or may not hold, and with wider consequences that we don't yet know in full. There might be some value in just taking a snapshot of what's happened to the investment trust sector and where it stands today as we pass this anniversary. It has been an extraordinary period with COVID, the Ukraine war, and now the Iranian war, plus, of course, the inflation surge that followed COVID and the higher interest rates that resulted from that, all of which have contributed to a very challenging period for the investment trust sector over the last 3 years or so. But that follows on an earlier period when the investment trust sector did extraordinarily well in the run-up to COVID, and indeed for a year or so after COVID, when more than half the sector was trading at a premium at one point. "You've never had it so good," said my first co-host Simon Elliott at the time, and how right he was. But of course, the question is, where are we now? And I think it would be helpful just to make a couple of comments about the health of the sector as we go into the 7th year of the podcast. We've seen a lot of shrinkage across the sector as boards have got round, some a little late in the day, I think, to dealing with the discount issue and the loss of demand for investment trusts, particularly many of the newer vehicles that came to the market in that boom period before COVID. There was hardly any IPOs of any significance in the last 3 years, and a steady stream of outflows from the sector as I said, boards get about the task of trying to rebalance supply and demand. We saw 26 investment trusts disappear in 2025, and another 40 or so are in the process of either winding down or have strategic reviews or considering exits or mergers. So this process of consolidation will certainly be continuing a little bit longer. But I think we are getting nearer to the end of that process. And of course, what remains, the trusts that have survived and have managed to put their own houses in order, will be stronger for that experience. The sector still faces a challenge in sourcing extra demand at the margin to rebuild the confidence of investors and to put the best things that investment trusts do in the shop window again with some confidence. We can't, of course, ignore Saba Capital, which has been very active, owns stakes in more than 40 trusts, some of which it has forced into liquidation or wind down or some other corporate solution. Very much a controversial actor in the sector, as we're seeing with the events at Edinburgh Worldwide and Impact's environmental markets, where 2 trusts that I think command the majority support from their shareholders are being forced into effectively actions that could well see them leave the sector, even though the majority of shareholders appear to be in favour of them continuing. Saba has been very effective at utilising their large shareholdings of between 25 and 30% in blocking what otherwise look like sensible solutions put forward by the boards of those trusts. We don't yet know quite how that's going to play out, but I think there is some reason to justify the complaints of the chairman of those 2 trusts I just mentioned, who think that the rules which have allowed Saba to exploit their minority shareholding and force action on boards that probably aren't in the best interest of shareholders has brought to the surface. We've seen also some progress on resolving the cost disclosure issue, where the elements of a solution are in place, but implementation still has to be completed. Obviously, the Iranian war has been a shock to the markets, has sent equity markets down and bond yields up. But there have been some statistics I might mention which at least give us cause to believe that the investment trust sector is continuing to do, at least in parts, what it's always set out to do, which is to offer investors an attractive alternative to open-ended funds, a more attractive structure, and has been delivering in a number of key areas. The very best trusts, the ones that have been around for long term with experienced managers and so on, have once again started to demonstrate their superior performance. So the average investment trust is once again outperforming the average open-ended equivalent, where those two can be directly compared across most sectors, not all, but the majority of them, which is an indication of the way that the structure can benefit shareholders, patient shareholders at least. And if I look across the performance numbers, it's interesting that if you look at the FTSE All-Share Index, of which investment trusts are a significant component, over the last 10 years, I counted them up yesterday, something like a third of the 65 best performing shares in the All-Share Index over the last 10 years have been investment trusts. They have actually produced a lot of positive double-digit returns for their shareholders, and I think that's a fairly creditable record. And it reflects the fact that, of course, that the FTSE All-Share Index is predominantly a UK-focused sector, but investment trusts have always provided a source of diversification into international markets. That was the real purpose why they were set up in the first place back in the 19th century, and they continue to offer that. And the great majority of those 20-plus trusts that I have identified as being among the best performers are those with international exposure. Those such as the technology trusts, one or two of the private equity trusts, surprisingly you might think, given where the discounts are in that particular sector, and others with global reach, such as JP Morgan, North American Income, Scottish Mortgage, of course, Pacific Horizon, and BlackRock World Mining. So there is encouraging performance. And in the last year, of course, we've seen the UK market perform very strongly, better than the US market, continuing a run that's gone now back 2 or 3 years. So overall, I think it's fair to say that some of us have been a little critical of some boards for being rather complacent and slow to act in dealing with the SABA and the discount challenge that they've faced. But I think it's also fair to say that the sector has been putting its house in order. It's doing what it always does when it faces challenges, regrouping and going back to the basics. It's been an extraordinarily volatile ride since we've started the podcast. But I think those of you who've been following us from the beginning will acknowledge that there has been a lot of bright lights amidst all the difficulties as well. Of course, now we may be moving into another difficult period. As I said, we don't know the outcome of the Iranian war and whether or not the ceasefire will hold, and if so, what's going to happen to the global economy. We know that oil prices and gas prices are going to be higher than they would otherwise have been before the intervention for at least several months. And it does seem unlikely that central banks will be in a position to reduce interest rates as many had been hoping. However, the game for investment trust shareholders has always been patient long-term investing. There is money to be made out of trading the discounts, and some shareholders have been taking advantage of that as discounts have started to narrow across the sector, still quite wide at around 13% on average. But we will see how much that resilience can continue to shine through the otherwise quite potentially gloomy picture that many investors may be afraid of. So that's a quick take on where we are in the investment trust sector. It's sometimes wise to stop while all the headlines are so negative and take perhaps a longer perspective on where we are. I should add that I'm very grateful to all of you who have been supporting the podcast over the last 6 years, and I hope that we'll still be doing it in another 6 years' time. Who knows where we will be at that stage. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector each week and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content weekly newsletter, now available with a 2-week free trial. There you'll find our in-depth independent profiles of more than 200 investment trusts and much more content. Go to money-makers.co/circle for more details. If you like this podcast, do please subscribe to the channel and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Find all those links on the website, money-makers.co. When I caught up with Stuart Widdowson, the manager of Odyssean, on Thursday this week, naturally my first question was to ask him to give a comment on what's been going on in the wider world. We've had the Iran war for the last month, And that has obviously trickled through to equity markets all around the world. From a point of view of a fund manager managing a UK small cap trust, what is your perspective on what's been happening with the Iran war and how that might filter through to the UK equity market, bond market, and everything else?
Well, I think we as professional fund managers share a number of the, should we call it, frustrations that private investors would have in this market, which is significant intraday volatility depending on what gets tweeted or what information comes out of social media from various parties. So look, there is a lot of fog around the situation that's going on, and it's creating uncertainty. The one thing that is certain is clearly the price of oil has gone up substantially. There is going to be a lag impact when we see that impacting companies in the investment markets. And the market's trying to, I think, guess whether or not it's going to be short or medium-term impact and which company is going to be impacted. But it's not just oil, as I'm sure some of your listeners know. It's other things that come out of the Gulf, things like helium that are very important for the semiconductor manufacturing process. It's things like raw materials for fertilizers. And if those don't get to areas that need to use fertilizers over the next very short amount of time, they're going to miss planting season, which has an impact on food prices next year. So the market's looking at all these factors and trying to work out actually which companies are going to be impacted, which companies aren't going to be impacted. The other thing actually that is certain is, I think, particularly for UK markets, prior to the end of February, everyone was expecting that interest rates would be cut a couple of times this year. And then suddenly gilt prices move substantially in the market to view, oh my gosh, we might have interest rate increases, which is a substantial change. So then people start to reassess actually what rating should we put on equities? Should we be buying? Should we be selling? Is the market going to go up? Is it more likely to be sort of flattish? It has all these types of implications. What's it going to mean for fiscal policy in the UK? So there is a lot of uncertainty. And a lot of these situations where there's a lot of uncertainty, people sit on their hands. So you've typically seen quite significant price moves with actually very little liquidity behind them, with the exception of yesterday. Actually, we did say there was quite significant volume on quite significant price moves yesterday. But the short answer is no one really knows. I don't think many people are making big bets at the moment.
Right. So it sounds as if, from what you're saying, and I would agree, that investors want to believe the best is going to happen out of this conflict in the Middle East, that somehow it's all going to get sorted. There will be some kind of ceasefire or uneasy agreement with Iran, and that therefore things will go back to normal. But there won't be the normal that we were thinking of before.
So again, we've been looking at saying that what happened in the 1970s, what happened in the last Iran crisis in 79, what happened with the spiking oil prices in 2002. How is it different this time? What's that going to mean for not just broader markets, but actually our individual portfolio companies? And that's really all you can do at this stage.
I suppose that if I just take the view that obviously emerged at the start of the war, equity markets down, interest rates potentially not going down or possibly going up. On the face of it, that's not particularly good news for the small cap sector in general. Smaller companies generally don't like that kind of environment, I think it's fair to say. But then, of course, small caps have been out of favor for a long time now. So I'm sure you will argue that they have been relatively cheap anyway, and therefore the impact might be more limited. That would be a kind of brave face to put on it, I suppose. Would you agree?
Yeah, possibly. I mean, capital flows also can drive rating changes in companies. So as you know, Jonathan, with our presentations, we put out relative valuations of the UK markets and UK small cap against global equities. We've been saying for some time, UK and particularly UK small is pretty cheap. The question is what causes that to change? And what we have noticed, I guess, a positive side effect for UK equities and small is the only game in town for much of the last few years has been US equities. And suddenly, with what's happening in the geopolitical sphere, people are starting to say, has that trade played out? And should we be looking for elsewhere to redeploy capital out of the US? And we have a number of international looky-likey peers who are good friends of ours, a lot of them based in the States, actually. And suddenly in the last 5 or 6 weeks, we've had loads of phone calls and people saying, gosh, we've seen you own this company. We quite like it too. Can we have a chat? And I think part of the reason is, although UK small companies is perceived by many people as a domestic play, actually there are many companies in small cap, and we own many of these ourselves, that are actually international companies that, for reasons of history, happen to have their head office in the UK. So if you look at the broader index in UK small companies, the average company derives about 60% of its revenue from the UK. If you look at our portfolio, it's only about 20. So actually what's going on, particularly in the UK economy with government decision-making, fiscal policy, is not as relevant as actually what's going in the broader world for many of our companies. And these are the companies that are we think very mispriced compared with their international peers. And that's why they're attracting overseas investors. So I think it's more nuanced, Jonathan. And there is still a big valuation gap with many of these companies compared with takeout valuations and also their international peers. So over time, those valuation anomalies tend to correct.
Indeed, and that's the argument for investing in the way that you do, the particular strategy you pursue. So I just want to ask you a question, I hope you'll allow me to do this, which is to talk about your track record. I mean, Odyssean now currently has a market cap of around 250 million, which is higher than obviously it was when you did the IPO in 2018. And I wanted to ask you how you assess your performance since the IPO. Now, I have a reason for that because on the one hand, the annualized rate of return since the IPO was certainly the end of February before the war started, was around 8%, I think. And that was actually comfortably ahead of your peer group and ahead of the comparator index that you give shareholders as a reference point. On the other hand, perhaps you might have hoped that it would have been better than that, particularly given the stronger start that you had. So I wondered how you would assess your performance over that period, given all the things that have gone on. And we obviously have to mention COVID and the Ukraine war and now the Iran war. There's been a lot of things going on.
I think it's a very fair comment, Jonathan. And look, events do happen. I think our strategy is not investing in index. So there are times when we are doing much better than the index, and there are times when actually we don't do as well as an index. And the variance can be quite substantial in various years. So look, you're absolutely right. We had a knockout year in 2022. We actually grew the NAV per share by 6%, and our broader market fell 22%. And at the time, we did say this is very anomalous to outperform a relative index by 27% in a year as a long-only fund. We will probably give up some of that performance. And look, that's what happened in 2023 and 2024. I think the key thing is we've not done anything different. It's really a feature of a couple of things. One is our sector focus. So we only invest in specialist industrials, TMT, services and healthcare. So there's a whole swathe of the market we don't invest in. Secondly, I think we had a lot of takeovers and realizations in 2022, and we redeployed capital. And the sector that looked really interesting at the time was industrials. I think the peak of the industrial earnings cycle for many companies was late 22, early 2023. And look, I think we got some of the cycle a bit early, and we got into that sector probably a bit too early than we should have done. And what's happened then is probably things deteriorated a bit further than we thought. And then a recovery in many of these end markets, particularly general industrial, semi, they just took longer to recover by about 6 to 9 months. On top of that, we had some volatility last year with tariffs. Tariffs was a very difficult period for relative performance last year. Now, ironically, if you went to go and buy a lot of shares in the companies that we own, there was no liquidity. And I was saying to the guys at the time, look, we've got to realize if we're buying institutional quantities, we just can't trade this. So where we did, we've averaged down. I think the other factor is, as well as having a lot of international companies, we also invest in companies that are going through significant change and self-help to drive their own returns. And what happened to us is, although a lot of change was happening that was very positive in driving results and in driving improved performance, it wasn't coming through in share prices. Now, what we've had subsequent to last year, if I compare 12 months ago, the world has realized that actually tariffs don't impact our portfolio companies as much as people thought. Okay. And secondly, we've had another kicker that the self-help that all these companies have been pushing through has suddenly become obvious to the broader investment community, and the shares have re-rated. And we've had a number of stocks that even today are up 30% this year because of the self-help starting to come through. So I think where we sit today, we would feel pretty confident about where things are going in the portfolio. We're aware that there's been a bit of a blip. We have bought into the blip and we've averaged down in many cases. And we're confident that some of these stocks really have the potential to generate pretty interesting returns and catch up a bit of the performance we've lost over the last 3 years. A really good example was Dialight, Jonathan. It was a real drag on our performance in 24. Last year, the stock went up 220% just because the self-help was starting to come through. So really, in short, volatility is a bit of part of what we play. We think about making money on a 3 and 5 year basis. We think actually, given the performance since we've launched, we're due a period of relative performance catch up.
And of course, you're also one of, I think, only 2 companies in the smaller companies sector of the investment trust world that are trading around par. You've only ever, I think, once had to buy back shares in your history. And that, I guess, will be interpreted as a vote of confidence by the investors who have followed you either from the beginning or come in more recently. You have issued shares once or twice. What's been the feedback from your shareholders during these very volatile periods?
Look, many of our institutional shareholders and wealth managers have been with us a long time, some of them 15 years, and they see years when things go really well for us. And in 2002, a number of wealth managers said, thank goodness we've got you because you're the only fund that went up in our portfolio last year. And we continue to say again, the very short-term performance can be quite random. We really focus on the long term. I think the drag on performance had gone on for some time. And I think people are starting to really question, if you change what you do. And, that was really sort of Q4 last year and early January this year. And I did say to the team, as soon as the questions start to come in, actually performance tends to improve because that's the way life works. And actually, the most difficult client meeting we had for some time was in the middle of January. And they were, I think, a bit impatient. And I said to them, don't worry, this will be fine. And literally, it was the day when our relative and absolute performance really started to motor. We had a very positive trading update from XP Power the next day, and the stock went up, I think, 40% in 2 weeks, right? So I think the key thing we've always sought with this trust, Jonathan, is to behave and also communicate that we are long-term investors. The short term can be quite uncertain, but we're very clear why we own the companies we do. And we have a very rigorous process, why we invest in the companies, how we monitor them. And look, it doesn't always work in the short term, but more cases than not, it works pretty well in the medium to long term. And if you get the right investors that understand that, they'll stick with you on the journey.
Right. Well, before we look at some of the potential catalysts there might be in your portfolio, I think you answered this question perhaps indirectly already, but we've seen a lot of volatility. You talk about the lack of liquidity in some of these stocks. Does that mean that you haven't actually made many significant changes to the portfolio over the last, say, 18 months of this great volatility that we've just been talking about? Or has it just been a case of, as you say, being patient and waiting for what you hope will be good news to come through?
Look, we always do an element of rebalancing. In our presentation, Jonathan, we've got quite a good chart which looks at the long-term EV sales of our portfolio compared with the last 20 years. So it takes a static view of the portfolio today and said, actually, how has this portfolio valuation changed over 20 years? And it's very informative because it effectively says for the last 18 months or so, these stocks have been trading on very, very cheap multiples. So a lot of it is then optimizing where you think the upside's going to be and how it's going to come. The most significant new investment we've made 2 quite significant investments over the last probably 2 years. One was in a Canadian listed company called Blackline Safety, which has been a great success for us. It was actually subject to a bid approach yesterday at $9 a share, and we bought most of the shares for $4 in May 24. So that's been a very good result for us. The market has hardly moved in that period. And the other one was a company called Genus, which is a global market leader in animal genetics, and frankly had always been too expensive for us. And the reason we looked at it is we rarely invest in companies above $1 billion market cap. This had fallen significantly. It had been classic fallen star, had fallen just below $1 billion. And we thought, actually, we can look at this now. And the more due diligence we did, the more upside we saw. And that went from not being the portfolio to at one point an 8 or 9% position. And that's worked out very well for us as well. So we've been opportunistic. The delay in the recovery of the industrial cycle has meant that actually we've continued to average down into some of the names we own there. But that has started to pay dividends in the last 2 or 3 months, as it's pretty evident that the long-awaited turn in the semi-cycles actually started to happen. So short answer, not very much, to be honest. Frankly, we're looking forward to making some more changes because there's lots of opportunity at the moment.
I think you only have 16 or so stocks in your portfolio anyway, so it's very concentrated. And the top 10 account for the huge majority of that. In terms of catalysts that might be coming up, there are a number of companies in your portfolio which either have announced or look to be in a position where some news will be coming quite soon. Perhaps you could give us, to the extent you can, some information about those potential catalysts and when they might be expected to materialize.
So in terms of specifically M&A, we had the news on Blackline yesterday, as I mentioned. We wouldn't be surprised if somebody else turned up and that situation became competitive. There's not guarantee, but our fact sheet at the end of March showed that Blackline was just under 5% of the portfolio and the premium is just under 30%. So everyone can make their own conclusion about what that means, but that frees up capital to redeploy. The other ones that are public, NCC is going through a breakup and it sold one of its 2 divisions and there's significant cash coming back in April, which we can redeploy. And for one reason or other, the market hasn't taken that breakup as well as we think it should have done. And it's public record. We've bought more shares than that. We think it's potentially a very mispriced stock. And the remaining business that's left is one of the world's only remaining scale cybersecurity companies. Now, the market has taken a very negative view on anything that might be impacted by AI. We think that AI is not a bad thing for NCC's cyber business. It probably provides as much opportunity as it does potential threat. And we see it as a very vulnerable stock unless the stock re-rates substantially. So I think that that's an interesting situation to watch. The other one, which is just outside our top 10, is Spire Hospitals. Now, we bought this originally coming out of COVID. We bought very well. And it had a bid approach a few years ago, which actually got voted down by shareholders. The board is going through a public process to see how to maximise value, which might include a sale. We expect there's going to be some news this quarter about how that plays out. Now, it's not the optimal time to sell that asset. In fact, it's the only stock in our portfolio at the end of March that had 100% UK exposure. And it has some reliance on government spending, which again is unusual in our portfolio. So provided the price is reasonable, we'd probably be quite happy to move that one on. The fourth situation that has had bid interest recently is a company called Auction Technology Group that had its largest shareholder make overtures, but no formal bid approach to the company early this year at a price that we and I think others felt did not represent anything like fair value. They subsequently said they weren't going to bid, which precludes them from bidding for another 6 months. But they've gone into the market and continue to buy more shares, and they're over 25% of the company now. So that's quite an interesting situation to watch. Outside of M&A, we have a lot of operational improvement coming through. And I think two of the situations we highlighted actually coming to January. For your listeners, probably defence is now a very exciting topic for investors compared with maybe 3 years ago being perceived as not fashionable. We have two portfolio companies that were pretty much the only two UK small cap companies in our view with defence exposure that hadn't moved substantially last year. Those were Gooch and Housego and James Fisher. And the order books, defence order books, in those businesses are growing very, very well at the moment. In fact, Gooch had a very positive trading update today. And it's good to see those stocks actually starting to move this year. So there's the M&A catalyst, Jonathan, but there's also other catalysts going on in the portfolio, not restricted to just, I think, people are seeing defence revenues in small conglomerates.
So just to be clear, one thing, because of the nature of what you do and the kind of businesses you're investing in and their revenue exposure, as you've mentioned, being mostly overseas, does it make much difference how the UK government behaves? I'm thinking of a number of aspects in which it could have an impact on performance of smaller companies.
So the answer to that is, fortunately, the government has very little impact about what happens in our portfolio. Where we have seen impact to the edges is around AIM and IHT. We only own two AIM stocks. One of them actually we bought around the end of the tax year because I think when we originally launched the trust, you can go back in the prospectus, and I think we said that we felt then that AIM stocks were trading on very unusually on a premium to full list small cap companies, and we thought it was is anomaly really driven by a very favourable tax environment with IHT at the time, IHT relief. And we felt it was unsustainable, and that has proven to be correct. The relief has been cut back substantially. Now, what we understand specifically going into the tax year just ended was a number of people were taking money out of direct AIM stocks and putting it into VCTs while you could still get 30% tax relief because that rule changed at the tax year end. So we saw probably sporadic selling literally in the last few weeks of the tax year end, which provided us with some opportunities to buy. Other than that, we don't really have that much direct exposure to what the government's doing. I think many of our companies that are involved in the industrials, they manufacture overseas, so they're not as badly impacted by the energy price. And for those that do have some exposure here, energy is a relatively low cost of what they do. I think if there were certain changes that were more favourable to business, particularly around taxation and energy, we might reconsider putting more capital into companies that were more domestically focused. But much as I hope, I can't see it happening in the short term.
And so, for example, reforms that would encourage or even enforce pension funds to invest in the UK and so on, that's not an imminent tailwind that's going to come to your rescue. They probably wouldn't be investing in your kind of companies anyway, even if they did.
No, I think there have been some talk about mandates being given to put money into quoted companies. Now, we've had a couple of discussions with big pension funds, but in reality, what they'd look to do is almost spread it across a quite diverse portfolio of companies rather than be quite stock specific in the way we are. Look, I'll believe it when I see it. By the way, I think the selling is gone, right? So it's now very, very difficult to get size blocks of stock in things we own. So the selling is largely gone. We've seen overseas people coming in and buying. And in some cases, actually, we've seen a return of risk appetite from retail investors. So if you look at the share price movement to Dialight last year, and you look at the trading volumes, the trading stats, it's very clear that retail investors saw the turn coming ahead of actually many institutional investors. And because the shares weren't very liquid, retail investors could benefit from the rising share price and get invested. Whereas if I wanted to buy £5 or £6 million in that as an institutional investor, I just can't, right? So there are elements to indicate that buying is coming back. Many stocks, as you know, are buying back their own shares, Jonathan, pretty much at an unbelievable rate. What we think will happen at some point is allocations will start to increase towards small mid-cap companies, and then eventually big institutions like the pension funds come in when the market's already gone up substantially. One of the more interesting charts we talk to clients about is inflation. So I don't think anybody believes that we're not in an inflationary period at the moment, and possibly exacerbated by how long things go on in the Gulf. If you look at the 1970s, small companies did really well. In periods of monetary debasement, small companies that are growing actually do pretty well, provided you don't overpay. And in the 1970s, I think they outperformed inflation by 11 or 12% per annum. It's phenomenal.
That was the origin of the so-called small cap effect, which was discovered, in quotes, by academics at that period. It's since been somewhat discredited, I think. But you're saying it's environment conditioned anyway, or could be to some extent.
Yeah. Well, again, we look at the performance against inflation of small caps for every decade since the 1960s. And this is the only decade where small caps have underperformed inflation by some margin. It looks very anomalous. So at some point, valuation gaps close. We just don't know when. Now, we're not waiting for that to happen. I think that's probably the cherry on top of the cake for us. I think where we're focused is companies that are improving themselves, so there are substantial discounts in intrinsic value, and those discounts tend to close.
And then if you're in the small cap area, it comes down to the extent to which you are deviating from the standard universe. You're not buying a very large portfolio, you're a concentrated portfolio, therefore it's all down to the stock picking. Essentially, that's what you're being paid for.
Yeah. Look, I think it's pretty brave for people to be really positive short to medium term about the UK consumer, about UK house building. Those are big proportions of small companies that are 100% based in the UK. I think life is tough at the moment for everything we're hearing. We can't see how it's going to get easy. And yet all these other international companies that happen to be listed here, they're almost being dragged down by the fact that they're attached to a lot of the domestic companies. And actually, a lot of them are doing very well. You look at the trading update from Gooch today. I think it's the highest organic growth it's had for many years. The semiconductor cycle is quite interesting. So the long-awaited next wave of capital equipment investment in the semi cycle appears to be now coming. It's arrived probably 6 to 9 months too late. Over the next 6 to 12 months, we expect anybody supplying into the wafer equipment companies to see their order books start to grow. And the operational gearing of these companies is very, very high. What the government does in the UK and how they do it is irrelevant to many of these companies. So really, that's what we're trying to do, is trying to find opportunities for companies to do well, despite what's going on in the domestic economy.
So finally then, Stuart, if I ask you what your ambitions are from here, in the past, we've talked about the question of whether or not there was capacity constraints in the areas you're operating. And I think you've said that you could comfortably still grow the trust from where it is now in terms of size without running into issues of that sort. And you've got, looks like, some money coming in the next few months, plus your shares are trading around par, so you, in theory, could be issuing some more shares. So what are your ambitions in terms of the growth of the trust from here?
Look, I think our ambitions of the manager are very similar to the board, which is measured sustainable growth from here. And part of that's NAV per share growth, and we're pretty positive about the prospects for the next couple of years. But also, I think we've issued on average 6 to 7% new equity per year since we've launched. We've got a high quality base of long-term investors. It'd be great to sort of continue on at that level. We have no ambition to go and do a 20 or 30 or 40% raise. It's not really what we do. The trust is quite close to about 300 billion. Once we get there, we think that potentially opens the trust up to be eligible for other investors that aren't on the register today. But I think it's really more of the same, albeit I think for the next 7 or 8 years, Jonathan, more of a tailwind rather than a headwind in terms of our asset class performance.
Well, let's hope that's the case. You actually have a quick word with the incumbent of the White House to try and tell him to calm things down a bit would be very helpful, wouldn't it?
Yeah, I'm not sure he'd listen to us. I'm not sure he'd listen to anybody, right? So.
I cannot disagree about that, that's for sure. So that was Stuart Widdowson, the manager of the Odyssean Investment Trust, ticker OIT, talking to me on Thursday when the markets were, I think, continuing to absorb and try to work out whether the ceasefire announced by President Trump is actually going to hold or not. That we'll have to wait and see.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.